All right, well, let's dive straight into it. We've only got an hour and there's a little bit to get through. So let's talk about why we're here. First, I want to talk about why 5 mil. I know it's a clickbaity headline, but there's actually some data behind it. If you look at this graph from Scaling Up by Vern Harnish, you can see that 96% of businesses remain below 1 mil. And most people might be able to get to a mil through just like hard work, grit, and hustle. But the barrier to get above $1 million, only 4% of businesses launch ever make it above there. And then you can see the drop off between a $1 million business and a $10 million business. Only 0.4% of people make it up there. So it's rarefied air, which means it's hard to do. And my whole mission is to unpack why that is so hard to do and tell you with the focus on the numbers how you can actually do that. So that's the whole purpose of this talk.
Cool.
Um,
Someone mute their microphone. Someone's got their microphone on, we can hear everything going on. The other thing, Michael, is do you want to hit view full screen and then we can see the whole screen, the whole slide?
Yeah.
If you just go to view along the top under yeah, keep going, yeah, view, there, and go down to full screen. Or slideshow, yep, slideshow, brilliant.
Perfect.
Yeah, perfect.
We're good. All right.
Cool, thank you.
So that's the whole point, is how hard is it to do it? And let's unpack why and how to get there. This is a really simple model of a business growing to $5 million. And this kind of tells the story of why it's so hard. You'll see every year has a different name. Year one is launch, growth, scale, establish, exit. And it depends on where you're at in the journey. These timelines are compressed. Obviously, people don't grow to 5 million in 5 years, but this shows the key models at the different stages. The one thing I want you to take away from this is that the net profit in years 2, 3, and 4, right down the bottom, struggles. It goes down to 3%, 4%, and slowly starts to build back in year 4. That's because the 1 million to 2 million and then scaling to 5 is the hardest on profitability. As you add your team, as you add a management layer, profitability really takes a hit there. And that's why having a really clear focus on your numbers and cash helps you get through this dip and gets you out to the other side. And the reason I've stopped it at a 5 million, I mean, I've got clients who are doing 10 million, but the reason this talk is about to 5 million is because it gets easier from there. You have more budget for more management team, and the whole P&L just has more space for those people. But during the growth curve, it's harder, and knowing when to hire and when not to hire and protecting your margin and your cash as you go is the key to getting through and to scaling to this number. And even if you don't want to go to that number, that seems overwhelming, these strategies will still help you get more profitable where you're at currently. So here's the big problem I see. Endless growth, more stuff mindset is ingrained. So more marketing equals more revenue, more customers equals more profit, which is not correct. More staff equals more successful. People always ask, oh, how big are you? How big's your team? Longer hours equals more productive. And I think these things are flawed. These are flawed arguments. We need to think about running a business in a different way. At each of these stages, there's a new set of problems that emerges for you to solve. So what got you to 1 mil won't get you to 3 mil, won't get you to 5 mil. And I want to ask you this question this morning. Are you the reason that your business is not growing? These are some of the common problems that I see. And then the two that I'm going to address this morning is the market-based wage for the founder and not understanding the financials. Obviously, your CFO is going to talk about this stuff, but there's some others on there that might hit home with you as well in terms of things that I think hold businesses back that I've seen firsthand. Quick intro. My name's Michael. I'm a qualified chartered accountant. 20 years doing this, first 10 years in big corporate. The last 10 years have been in helping small businesses, and the last 5 years have been purely helping agencies full-time as a fractional CFO. In fact, I launched as a virtual CFO because that was the name back in the day, and now the market seems to have accepted fractional as the way to go. And I help you deliver financial strategies to help you grow your business. A little bit of background about who I am as a person. This was me before. I still surf now and again and surf lifesave and sail, but this is me now. We've got a 10-month-old and she's kind of dominating my world. So that's kind of life for me. Here's the simple like one-liner of what I do. I help you grow your profits, stack your cash, and give you a forecast or a plan to help you get there. Those are the three main things that I help deliver for my clients. And that's what I love talking about. I love the game of business. So it's a good fit. Just want to define what a fractional CFO is. For those who may not know, I kind of look at your finance team as a triangle. Bookkeeper, super important, getting your zero file clean and up to date. Tax accountant, very important. They do your compliance. They make sure that we don't pay a cent more of tax than we need to and help you with tax planning. And the CFO or the fractional CFO, outsourced CFO, we are there to talk about the future with you. We are there to talk about the strategies to get you where you want to go. And that's where a lot of the through line for this talk will be. It'll be on future focused strategies to improve your business. The other two, a little bit more backwards looking, historical looking, which is why I always struggled with the identity of an accountant, because I always hated looking at history. I always wanted to know, like, what are we doing moving forward? So this is the perfect role for me. A couple of success stories. A couple of years back, we helped one of my clients exit on a 1.3 return on annual revenue. And that was a fantastic success story and got a lot of pride from seeing them have that life-changing exit. And then another one last year, we saved with a restructuring strategy. We actually wiped 200K off the ATO tax debt, and that really helped them turn around and stay in the game. And they're still going today, which was another huge win. But enough about me. Let's talk about you. I want you to imagine a future where you're not wearing so many hats, constantly having to put out fires. You've got a motivated team who are committed for the long term. Got a portfolio of happy clients who value what you do and respect your boundaries. You always have enough cash for those surprise costs that pop up. And you draw a great wage from your business and still have a quarterly dividend to maybe reinvest back into the business. You don't have to steal more cash. And where you have certainty in the future of your business and how to get there. Maybe you're fielding offers for your company because it's profitable and it can run without you, and that's appealing to an external person. But maybe you refuse them because you still enjoy what you do. You get purpose from it. How good would that be? Sounds great. What's his future worth to you? Well, it doesn't have to be a pipe dream. Let's talk about how to make it a reality, and these strategies will help you get there. First, I just want you to have a look at where you're at on this North Star journey. So you'll either put yourself into launch, growth, scale, established, or exit. And so you'll either be doing $500,000 a year or below, 1 mil or below, 2 mil if you're scaling, and then established is 4 mil and beyond. So the two main things that we're going to talk about today are the growth and scale, which are the hardest to get through and the most common. But I want you to kind of earmark where you're at on this business growth journey and have that in the back of your head while we talk. So the practical steps to grow your business. Fairly simple, fairly straightforward. I'm sure you guys have been told a few of these previously. Starting from bottom left, improving your client retention. So stopping churn, finding more leads to fill the top of your funnel, increasing your conversion, increasing your transaction value with upsells, cross-sells, going up market a little bit, and then getting people to purchase more often if possible. Those are all like the revenue drivers for your business. And then here in the square are probably the more practical CFO cost-related ones. So reducing your cost of sales, finding efficiencies in how you deliver. So for an agency, that is delivering the work with less headcount or not having to keep hiring more people as you sign more clients, finding some efficiencies to do that without having to constantly hire. And then also staying lean, reducing your overheads, trim the fat, which we're going to talk about today in terms of finding margin. So those are like the practical steps to help you get up the growth curve up here, right? If you sell like crazy, focus on all those things, the numbers, you might get there. You might grow from one step to the next. This is a framework I built to help people along that business growth journey that I think has a huge impact on whether they'll get there or not. I think the first problem I always see with new clients is that we need to fix their margins. They have a broken business model or they don't know what their numbers are actually telling them, like they're looking at the wrong numbers. Then we have to solve the cash crunch as you grow along that curve. And then eventually you'll start building real value. You'll build a management team. You might build yourself out of it. You might build a brand, those kind of things. But it always starts with number one, fixing your margins. And then number two, solving the cash crunches. As a CFO, those are the two key problems that I see as people try and grow and scale a business. So we're going to focus on those two ideas today. So have that in the back of your head if you're a growth, scale, or established. And then from these strategies and tactics we're about to talk about, please don't get overwhelmed. Just take one or two things, one idea you might think work for you, and maybe you can implement that next week. So just what's the biggest impact that you can have and implement that. Don't try and do everything at once. Just find the one that you think will move the needle the most for you. So let's cover the growth stage, which is here knocking on the door of around $1 million. But these ideas also work if you're below $1 million at the moment. So don't fear. What goes wrong at the growth stage? So they don't know what business owners don't know what their numbers are telling them often. If they are looking at a P&L, they've distorted their numbers by accident or neglect. And this leads to poor decision making. So without a true understanding of where you're at, how can you make a clear decision on where you want to go? And that means the founders are flying blind. They don't have accurate data, and it doesn't reflect the reality of actually what's happening to the cash and to the movements in their business. Had a recent sales call with a couple of founders at the moment. We're doing around 18 to 20% net profit, but neither of us are taking a wage from the business. So my immediate reply was, well, you're not doing 18 to 20% net profit. If we put in a wage for you guys, you're probably breaking even at best. And that clearly shows one of the key distortions that I see all the time. This is the growth challenge, I think. And this is the reason why only 4% of people ever get beyond that $1 million mark. Founder launches the business, they search for product market fit, and then the killer is number 3, a poor initial pricing strategy. You struggling to get leads, so you discount or you start at a small pricing point, and then the founder gets trapped because you can't hire anyone because you're so cheap. So you don't have any margin to hire someone or to make any moves because your starting point for your price was incorrect. Founder gets trapped, struggles with profitability, try and go up market. The old clients don't want to wear a huge price increase, so you've got to find new ones at a higher price point. There's a bit of imposter syndrome. I see it again and again. And then the founder can't focus on growth because they're busy putting out fires and in that kind of trap. And it leads to a lot of burnout, leads to a lot of stress for founders, and it's why so many businesses go under, in my opinion. Does that sound familiar to you? So here's what's happening under the hood. So you're underpricing your product because you don't understand how much it's costing you. And you may not know the unit economics of what you should be charging for your retainers. They might make up for a lack of wage, so that a founder may be discounting what they're taking from the business. So they'll run personal expenses through the business to cover, take out money willy-nilly through owner drawings. That hits the balance sheet, which 90% of founders are not looking at or understand. They might look at their P&L in Xero occasionally, but many are not analysing the movements in their balance sheet, which is where your owner drawings are taken out of. And you can't see these hidden risks piling up. Like the cash flows of your business, you're completely invisible to you. And then things like this start to build up on your balance sheet as well. And these are some of the hidden accounts you should be looking at. Your ATO debts, so the liabilities to the government that sit on your balance sheet, credit card debts, bank loans, overdrafts, and staff liabilities like their super, things like that. Those are the hidden traps that sit on your balance sheet that founders don't look at enough, that can build up. And you think you're doing well, you've got some cash in the bank, but then one of those bills rocks up next week and you are stressed because you don't have money for it. So this is the kind of lack of clarity that I think makes it hard for a lot of founders to make decisions. So here's what you need to do. Pay yourself properly first. So the founder needs to be taking a market-based wage out of payroll and it's hitting your profit and loss for you to truly see your business model as it stands. If you're just taking out owner drawings, it's invisible to you and you don't know what your business model is because the most expensive person in the business, i.e. the founder, isn't putting a wage through the business. So that is step one. If you're not doing that, Start small. You can build up to a market-based wage if you're currently underpaying yourself, but just put something in there to begin. And that means you can run a P&L and get a feel for truly what's happening in your business model. Then you need to fix where you're out of balance. So that will then show you what your true business model is. So then you'll have to address the other problems. So you might need to improve your margins in certain areas. You might need to trim your overheads, or find real product market fit and adjust your pricing strategy. And then from there, you set clear benchmarks and you stick to them. You want to keep your business model in balance as you grow. And I'll show you how to do that now. So you can know big picture, we are on track. So some real world examples of where the money goes. So this is stuff I've seen, war stories. Owner greed. Owner might boost their dividend payment because they've got personal things they want without thinking about taxes or reinvesting back into the business to build cash, to build a bit of cash cushion. Team costs is a massive one for agencies, obviously. People think their growth will continue forever. You know, they just think that this good sales run of the past quarter will be infinity, and they make an expensive new hire. Throws out your profitability. Or the wrong hire. This is like a productivity problem where you hire the wrong person for like an expensive middle management role and they have a bad impact on team culture. All the other people in your team don't like them and it has a huge downward spiral. So like not just the dollar cost, but the productivity and culture cost of the wrong hire at the wrong time. And then business ego creeps in as well. You may think that you want to get bigger clients by having a big expensive office, that'll wow them. You know, fancy leased European cars, all these things. I think founders have a classic fallacy that you are spending this money to save it on tax, but you're spending $1 to save 30 cents. It's a really bad deal, and they're spending things on stuff they don't need. What you need to do is have clear benchmarks and stick to them. And I think common sizing is the best way to do this. It's the simplest way to do it. And this holds up whether you're a $1 million business, whether you're a $10 million business. I do this exact same process for both. So you probably have heard of net profit, right? I'm sure most people, business owners, would know, yeah, profit, I need that. That's just like the most famous of all the common sizing stats you can have. Net profit is just your profit as a percent of your overall revenue. And then the other ones that we want to be looking at is your overall overhead as a percent of your revenue and your team cost as a percent of your revenue. So say you've got $100 of revenue, $50 of that went to labor, you've got a 50% share of that, of team, and then cost of goods sold. This is a rough benchmark for agencies. In the past, probably 5 years I've been doing this. Direct labor is creeping up closer to 60% of rev for a lot of agencies. You know, COVID, there was a lot of pay increases and that kind of stuff. So 50% may be, you know, ambitious for some agencies, but that is a good benchmark. Overhead, you don't want to be making up more than 20% of your revenue. So if it is for you right now, you need to cut something that you're definitely overweight somewhere. You need to work out how to cut it. And COGS, that can change depending on how many subcontractors you have. So for a lot of agencies, right, they might have more subcontractors. Some of them might have more team. So sometimes that's a movable target. So don't read into COGS too much. It just depends on what weighting of contractors you're using versus internal team. But get a read on where you're at for all these things and then track your progress as you try and improve them. And you can do this at a $500,000 business. You can do this at a $10 million business. It still stacks up. Your business model needs to be in balance, and doing this will help you work out if you're in balance or you're out of balance. Here's how I do it practically for people. So we run something like this at the bottom of their P&L, and we have a look at some more detailed accounts. So cost of sales, you can see I've got the goal 5 to 10%, and then we're tracking it how we went over the past few months. So you can see cost of sales is at 9% for Jan. It's okay, right? It's just a little bit high, but within target. Gross margin, 91%, so just above target. And then direct labor, you can see my goal there is 45 to 65%. It is a bit of a range. It depends on how big the agency is. The bigger the agency is, the bigger that number gets usually as a percent. Marketing, 5 to 15%. You need to be spending something. If we're in a big growth phase, maybe you are pushing to 10% of your rev you're spending on marketing, but that's another benchmark. And then I separate the other costs into facilities and other OPEX. And then sometimes we track management labor separately. But tracking everything as a percent of revenue over the months, having a look at the trends, and then knowing if you're close to that benchmark will give you a clear indication of if your business model is in balance or out of balance and where you need to go to start trying to hunt margin and cut costs. So if I want to pay for your coffee this morning, what I would say is after this call, go and add up all your overhead, divide it by your revenue, and be like, are we 20% or are we less than 20%? If we're over 20%, that tells me that you're overweight and you need to start cutting. So maybe try and hunt there first for some margin. Things like subscriptions, obviously, is low-hanging fruit to cut some stuff there. So some practical tips to fix your margins. The first one is to stop underpricing. So charge out your team at least 4 times their base hourly cost. So, at least a minimum charge out rate of $150 an hour plus, definitely. So stop underpricing is the key trap, as I said, that founders get trapped in their business because they're not pricing their products correctly. Stop overservicing. So having clear scope and expectations with clients and a system to spot your out of scope work and offer an upsell or a cross sell. So that's a killer for agencies. Everyone is overservicing that I see. So having an ability to say no and upsell will give you freedom and help you grow. Third one, be ruthless with overhead. So regularly review and trim the stuff you forgot about. I just gave you tips on how to do that as well with benchmarking and common sizing. And then get super efficient. So maybe focusing on less services to reduce overwhelm, getting efficient at your best, 1 or maybe max 3 products or services you do, and automate, get it as as efficient as possible, which means you can probably run it with less staff. But if you're all things to all people, offering everything, you'll never get super efficient because you're getting pulled in so many directions. So owners often think they need to pay themselves less to help them grow. But as I've shown you, it's the exact opposite. If you don't put your market-based wage in, you don't know what your business model is telling you. You have to have a sustainable business model first, where you're at right now, before you try and scale your top line, or you're just going to scale your problems. And I see this again and again. People think that more revenue will fix a broken business model. You're just pouring more water in a leaky bucket. So get your model in balance now, wherever you are, and then you can grow from there. This is a great quote from, if you haven't read this book, I highly recommend it, The Psychology of Money. Spending money to show people how much money you have is the fastest way to have less money. And I think we all fall victim to it sometimes. But that's just trying to inspire you to stay lean in the overhead, to reduce those ego expenses, and to know that you're focusing on the end game of a profitable, sustainable business with a cash cushion built in. And we're going to talk about cash shortly. So that was growth stage. Those are some of the key problems. Those are some of the ideas to find some margin and to obviously benchmark where you should be. Let's talk about the scale stage. So this is when maybe the sales are taking off and you're starting to get a bit of momentum. You beat that $1 million mark and cash flow challenges start to creep in. So what happens at the scale stage? What got you here won't get you there, and your revenue is a vanity metric. So it's how quickly you can turn this into cash and how much you can keep in cash is where the real winners and losers are separated here. And that little bit of success, you're hitting maybe above $1 million. This is when the ego stuff really creeps in. You might need that bigger office or that nice car to prove that you're a success because you've been working so hard for the past few years. But the problem is that cash flow disappears. They do everything right, but they don't manage their cash. And even though they are at this big fancy revenue or headcount number, all of those numbers get bigger and riskier. Your payroll gets bigger. The super you owe to the government gets bigger. All of those swings in cash get bigger. It's harder just to patch it over with a couple of extra sales, and founders don't realize that. So you've done a lot to get here. Well done if you are here. I'm sure it took a lot of hard work and sacrifices, but you got to get serious and plan for your future. So here's a question for everyone at home this morning. Have you ever gotten a tax bill for last year's result or maybe for last quarter's BAS, but you got no cash to pay for it? Or maybe you've got like just enough cash, but then your overhead, your operating expenses account is gone. You've got no cash left. You're not alone. I see it all the time. You would be surprised how many people have an ATO tax debt. Almost every business in Australia that goes under owes the government some money. It is super common. So here's what you need to do. Reduce your cash conversion cycle and build some cash runway first before you try and scale. So that is reduce the time it takes to get cash in your bank and then having some in reserve for a rainy day. You also should be forecasting and planning ahead, having some way to think about, predict the future. So you can build a tool in Excel or Google Sheets or use software like Fathom or Spotlight, which are slightly more automated. But the key thing here is thinking about the future. Having any sort of tool to do it and to plan what's coming ahead is really the key here of actually doing it. And you can model the impacts of decision, like hiring, investing in a new website, what other things are coming up into the future. And then tip 3, check your ego. Stay humble, stay lean. For every dollar you're spending, is this money creating ultimate value for my customer? Is this moving us towards our ultimate goal? Or is it just a shiny object that I'm frittering away my money on? Here's a little cartoon I did of the cash crunch. Very common situation. So on the right, we've got our painful client who can't pay us till next month. But we owe the tax office for a BAS and the team have their payroll today as well. And this is a common problem that the owner gets into, right? But luckily in this situation, you can see our fearless owner down the bottom right had some cash reserves on hand and was able to make payroll and the tax office, even though the client hadn't paid them and they had to wear it. So in this situation, this agency owner had to act like a bank, right? They had the cash to provide, even though the client really should have been paying their team's wages for all the work that the team just did for that client. Oh, wrong way. Give me 2 secs. There we are. So this is the cash conversion cycle. Don't focus too much on the right. That's just a calc of how we can prove that we can get more cash in your bank by reducing this time. Have a look at the cycle on the left. So think about for your own business right now, from when you sign a new contract or sell a new retainer, how long does it take till obviously you're shipping that, delivering it, and invoicing it in total, do you think? And then once you've invoiced it, how many days is your invoice terms? We want to shorten that cycle, and it can have a huge impact on how quickly you can grow your business. I've seen some clients with amazing success where they shorten their onboarding cycle, sign them up as quick as possible with an invoice with super short terms, 7 days, 14 days, collected it quickly and just got them moving and got them in the world. They were doing really long onboarding audits at the start, sometimes took over a month, and then they would invoice. So sometimes they were doing 2 months of work before they ever saw some dollars in the bank. So have a think about what you can do to shorten this cash conversion cycle for you. Can you charge up front? Can you do a paid onboarding? But you want to get cash as quick as possible to help you grow. Otherwise, you're acting as a bank and you need to hold more cash on hand in order to sustain these problems. So where does the money go? This is the killer. I mentioned the ATO debt at the start. Founders don't realize that every $1 you receive into your bank, roughly 30 cents is not yours. It's the government's. And when I say the government, I mean it's maybe your staff super, your staff's income tax withholding, it's GST, it's your pay-as-you-go installments for your company tax that you have to do quarterly. It's essentially not available to invest in your business or for you to take out of the business. So this is if you take one thing away from today that'll keep you in business for the long term, I think it's this. If you have the discipline to not touch 30 cents of every dollar, you will build cash in your business and you will have cash set aside for these big costs that come up. But that takes discipline and that takes saying no to shiny objects, and that might take the need to cut overheads. And then this is why every business that goes bust has an ATO tax debt. You don't realize that 30 cents on the dollar is not yours. Our owners are like, hey, look, we've got enough cash in the bank right now. We just got 2 invoices in the door. So they spend the government's money on other stuff. And they might invest in too many areas at once. You make the expensive hire. You also invest in that website project. You kind of stack too many things in a short time period, and you wear a bunch of big costs. And then all it takes is losing a couple of clients the next month, and you're in a really tricky situation. And then they may not even monitor age receivables or collect the cash that should be in their bank account enough. So they'll let all that ride, don't chase their customers. And maybe you'd have to use a credit card to start paying all this stuff off. You're paying rip-off interest. So you're losing, 2 to 3% of revenue on interest charges, which is, I hate, and they're such a waste of money. This is a really common trap that I see again and again. So if you take anything out of that, it's to set aside that cash. It's not yours. Here's some practical tips. So implement some business buckets and build discipline to set aside funds and not touch them. I'll show you a simple system for that shortly. Optimize your payment terms. So collect up front where possible for those retainers, or shorten your payment terms as short as possible. Or if you like, I got some agency clients who we serve, like tier 1 big corporates, we still have to stick to the 30 days. But we are relentless. Like on day 30, 31, we're like, hey, just checking in. Where's our money? Because we want to hold them to account, and we want that cash as quick as possible. So look at age receivables, gently follow up with people on ideally a fortnightly basis. And then critically forecast any big investments ahead. So if you're going to make a big purchase, a big scary one, have a think about the future, have a way to think about the future, and just make sure it makes sense with the cash you've got currently on hand. Is there any other big costs coming up? What's our sales pipeline look like? Do I have confidence to make this big investment? And that will ensure that you don't run out of cash. So the business buckets, there's a few very famous systems. Barefoot Investor, which I use for my personal world, he uses the same psychological principle. Profit First is another really popular one. I just call it business buckets. It's the same psychological principle, which is allocate money into different bank accounts, and that's what their purpose is, and do not steal between those bank accounts or buckets, right? So you know that this is the system, and that you can't touch that tax 30% because it's not yours. So you have to make do with the rest of the cash for the rest of the business. And if you're running out of cash in those other bank accounts or in those other buckets, that means you need to cut overhead. You can't steal from the government money. And it helps you stay lean. Basically, the biggest benefit is for you to stay lean and for you to be able to see, oh, you know what? Cash is a little bit tight. We can't touch the BAS money. What else can we do? And it keeps you accountable to not spending too much cash. It's a really simple but effective cash budgeting system, especially for small business owners who don't maybe have a full-time finance department and get to run forecasts every week. This cash budgeting system, it works. That's why Profit First is so popular. It's why Barefoot Investors system is so popular. It's because psychologically it does work. And I use Profit First for my business, and I use Barefoot for my personal, and they really work. And Profit First is basically this kind of same principle. So another tip, if you take it away, would be to set up a BAS or a government money bank account for today. And maybe you don't start with 30 cents on the dollar because that's a bit aggressive and you're not used to it. Maybe you put 10%, 10 cents on the dollar into that. So every time you get some revenue in the door, or every month you get all your invoices paid, take 10% of that, put it into a government bank account, see how you go with that, and then maybe you can ramp it up a little bit, increase that percentage as you go. This is what forecasting the future can look like for you. Doesn't need to be this fancy. It can be simple, but this is a way to have a look at what your P&L is into the future. You can see this looks like a classic P&L, right? Revenue, expenses, some profit down the bottom, but we're also critically tracking the cash balance at the end, and having a way to plan for the future, big costs coming up, having an ability to talk about what revenue is going to look like into the coming months, and having an ability to plan what our team might be to meet that revenue. And critically, if you can see, you may not be able to see it because it's too small, but you can see all the common sizing I'm using here, right? So there's labor as a percent of revenue, just under the team costs. There's gross profit margin underneath gross profit. You can see under operating profit, we've got a percent of revenue there too. Those are all my little triggers to tell me if this business is in balance and if we should be making an investment in overhead, because maybe it's taking us up to 28% of revenue. That's out of balance. That's probably not a good investment. What else can we do? So that's a way for you to use that benchmarking, think about the future. And then you can run some very simple graphs of what your P&L is into the future, rather than just looking at it all historically. And you can see we're predicting that we're going from an overdraft position here in August to slowly building our cash back till the end of June 25, which is awesome. So we're kind of plotting our path back to a healthy cash position, and having this kind of visibility again helps you stay on track with making the hard decisions and staying true to your plan, because you know that you're building towards something. But if you don't have this kind of visibility, it's hard for you to stay true to the plan and you just get blown around in the ring.
Shush. Shush.
So that's what it looks like to forecast your future. And then some cash benchmarks for you. Ideally, you're building 2 to 3 months of cash on hand, or your war chest, whatever you want to call it, as overhead into your business, as working capital in your business. Small business owners often keep it way too lean. So I really highly recommend trying to start building 2 months of runway into your business. And when I say runway, what I mean is take like your total monthly wages and your total monthly overhead, times it by 2. And that's a goal cash runway for you. If last month's wages was crazy, just take your average monthly wages over the past 6 months, take your average overhead over the past 6 months, times that by 2, just to kind of normalize it a bit. But you want to be able to have some cash if you lose a couple of big clients or some big unexpected expenses come up, and they always do. Something will happen. If you're in the game long enough, things always pop up. So make sure you stay on track with that. And you can see that's a benchmark I keep on my forecast to make sure that we're close enough to that. And if not, that is always a focus for me. So if you want to scale up the business growth curve, you must be disciplined. And true wealth lies below the surface. It's not the flashy cars. It's not the fancy offices. It's that business owner who's sleeping well at night because they've got 3 months cash runway in the bank and they know they can sustain a couple of dips. That is true wealth for me, and that's what I try and advocate for my clients. Little Warren Buffett quote for you. Someone's sitting in the shade today because someone planted a tree a long time ago. So now is your time to plant some trees, so you'll be sitting in the shade in 3, 4, 5 years' time. But you need to do the hard work now in order for that to happen. I'm a fractional CFO, help people with this kind of stuff. Won't go too sales on you guys for the thing. I'm part of the community, so we'll be able to chat in there. And if you're interested, this is a book covering some of these concepts. So if you want to go a bit more in depth on that stuff, I've got a few case studies in there. It's all tactical, kind of talking about similar concepts, but in a little bit more depth. Feel free to scan that QR code and you can read the ebook for yourself and yeah, get an understanding of my perspective. But that's it, Laura. We can jump back. Would you like me to unshare my slides, perhaps?